John, good to have you with us. Let's start with the name Prudent Speculator. What is prudent about speculation?
Well, the founder of our firm was Al Frank, and he launched the newsletter in 1977 as a diary of his investment experiences. And Al very much viewed investing as looking forward. You're always trying to figure out, what a company is worth, where the markets might be going forward. So you're always looking through your spectacles, if you will, and speculating about where things will be. And so you can either do that with some system or some prudence, or you can do it the way, unfortunately, many investors do it, by jumping around from strategy to strategy.
Talking about strategy to strategy, everyone is in favor of discipline. Then the market goes down and discipline goes by the boards.
Right.
You describe yourself, as almost everyone does, because it's a nice word now, value investing. What is your definition, and what do you do differently from others who affix that name to whatever they do?
Well, value investing, if you look at market history, companies trading at inexpensive fundamental valuations, low price to book value, low price earnings ratios. These are the kinds of companies that have historically outperformed. So of course we focus on those types of companies. We're a little different than the other boys, as I like to say, in terms of our value bias, in that we like technology stocks. Historically, technology stocks trade for higher multiples of book value, higher multiples of sales, and so often they're not classified as traditional value type stocks. We do find value in tech. Generally speaking, you have great balance sheets there, you have above average growth potential, and nowadays, with a lot of the larger cap tech names, you have generous dividend yields. So we like technology. We're also underweight financials relative to where, say, a Russell 3000 value index would be. And so we're just not comfortable having 25 or 30% of our portfolio in financials when, of course, you can have a company, have a $13 billion write-down. Oops, maybe it's $14 billion, maybe it's $12 billion. And then they can make their numbers simply by massaging, if you will, the loan loss reserves and things like that. It becomes very hard to predict, if you will, where those earnings might be going forward.
Talking about banks just for 1 second, why don't you like them after 5 years? Presumably they've strengthened their balance sheets and
Right.
cleaned things up.
Well, I shouldn't say I don't like them. I'm underweight financials. So we do like names like JP Morgan, like Wells Fargo, like HSBC, like BB&T. We also just invested in a CIBC out of Canada, ticker symbol CM. So we do like some of the banks that are out there. We're just not choosing to be overweight in that particular sector. And again, what we try to do is focus on quality. I know when I say JP Morgan and quality, some people might raise an eyebrow or two. But we try to focus on those companies that were acquirers during the mess that we had from 2007 to 2009. Because just like in the S&L debacle in 1989-90, though there were many companies that were able to go out and buy assets on the cheap. Now, the jury is still out on whether JP Morgan bought, Bear Stearns and Washington Mutual on the cheap, as they keep writing checks to, the government and the Justice Department and so forth. But I do think that many of the companies that were able to make those acquisitions are going to benefit in the fullness of time.
Now, in terms of value, you mentioned the traditional things. What's the extra ginger that you put on it?
The gray hair. Well, I've been at this for 26 years now. I, believe it or not, started with Al Frank in 1987 before I graduated from college. So I'd like to think that I've learned a thing or two about, evaluating companies and that qualitative piece. Anybody can do, well, not anybody, but a lot of people can do the quantitative portion, finding companies that trade at those inexpensive valuation numbers. We've actually created our own proprietary algorithm that screens 2,700 companies every day on a variety of factors, and we think that our value-based criteria is a better initial pond generator. We like to say we fish in the right pond. So we like to think that our valuation metrics and the combination we use of them is a little better than the traditional value manager. But there's still that qualitative piece. You're trying to figure out if a company is making buggy whips, right? Or if it truly has, something that is sustainable and or if it's in a downtrend right now, if things will, improve as the economy improves or as their product cycle changes or those sort of things. So believe me, there's a heck of a lot of art that goes into the science. And that's why, you just, in my humble opinion, you just don't want to go out and buy like the Russell 3000, index fund or Russell 3000 value index fund. You want to have active management.
Before we get to index funds, the role of dividends, how big a role does that play in your world?
Well, we really like dividends. You know, I've published special reports called The Value of Dividends. Dividends historically have been a significant component of total return on stocks. Now, I know dividend yields at 2.5% are relatively low, you know, historically. But of course, if you think about what you're getting on cash investments, money market funds, CDs, even treasuries, you know, you got to go out, you know, 10-year treasury just to get a yield that is, you know, comparable with what you're getting on stocks. So dividends are really an important part of what we look at. And further, the analysis we've done, we do a lot of back testing of things, shows that dividend-paying stocks have been less volatile or less risky over the long term. Their zigzags aren't as wide as non-dividend payers. And believe it or not, they've generated higher long-term returns. So, you know, higher returns, lower risk is sort of the holy grail for investors. And in this environment where stocks have rallied so much, you know, we really do want to have some safety, you know, in our portfolio. So if I was a, you know, unabashed bull, I would be out in micro cap and small cap high beta stocks because those, you know, would generate significant returns when the market is doing well. You know, the market has done great. We've done just fine, thank you, but I think we're doing it with a little more margin of safety, if you will, with having a dividend-focused portfolio.
Is there a dividend bubble? Because you're not the first to observe dividend yields, low though they are better than money market yields.
Yeah, it's interesting. You know, earlier this year, that was the question that was asked, and we saw a pullback. You know, when the worries about Fed tapering, rising interest rates, of course, the higher yielding stocks in the utility space, in consumer staples, right, in some of the energy names, the REITs, they got beat up. And so in our mind, there's actually good value there now because these are some of the areas of the market that haven't performed or have actually gone down in price this year. And so if anything, there's been an over-penalization in my mind for higher yielding stocks this year. So I still think there's value in dividends as we go forward, and I would not be in the camp that says you want to somehow shun, you know, getting that income stream. Now bear in mind, we don't just want the dividend payment, we want capital appreciation first and foremost. So it's capital appreciation with dividend income. And, you know, oh, by the way, if I can get my stock to go up in price and have some income along the way, you know, the more the merrier.
So how do you evaluate sectors now?
Well, as I look at the market, we've certainly had a significant advance in many different industries. And many different sectors. And so I still think it's a stock picker's market. Now, there are areas of the market, as I mentioned, we're underweight, you know, in financials. We're overweight in areas that haven't performed as well, because that's where the opportunity is today. So areas like energy, areas like materials, you know, gold mining stocks have been crushed, right? And I think they've been crushed far more than is justified given the drop in gold. So a name like Newmont Mining is attractive. A name like Barrick Gold is attractive to us. Also in materials, a name like Mosaic in the fertilizer, potash area. These are all companies that have actually declined in price this year. You know, imagine that. We have a market that's up 30%. And we actually have some stocks that are down, and in our mind represent value. So materials, tech, you know, we're overweight technology relative to other value managers, and a lot of the large cap tech names look very attractive to us as well.
What happened to gold? Why such a sharp fall off? Because gold mining has done even worse than gold.
Exactly. Well, you know, gold obviously had a fantastic run, and I would argue that a lot of the reason for that is the democratization of asset class investing. You know, if you think back 10 years ago or so, if you wanted to buy gold, what would you have had to have done? Get the bars, the coins, you know, those sort of things. Nowadays, you go and you buy GLD with a mouse click, right? Oh, I want $1 million in gold, boom, and you're done, and it costs you, you know, $5 in commission or nothing in commission to trade gold. So there was a vehicle that created an opportunity for investors to use that in their portfolio. And of course, nothing was more bullish than something that went up every year. And of course, gold had a fantastic ride. And believe it or not, the GLD ETF, at one point in 2011, I believe, was worth more than the S&P 500 ETF. So more assets in GLD than in SPDR, right about the time that gold peaked in price, right? So gold has certainly had a tremendous pullback, primarily because investors have decided that it's no longer an asset that they're interested in investing. But if you think about what the Fed has done, printing all this money, you would think that there will be inflation coming down the road, and you will think that gold will again have its day in the sun. So we think having a modest exposure to gold in a portfolio, our portfolios are broadly diversified, makes some sense.
Timing, market timing. Fool's gold?
Well, the only problem with market timing is getting the timing right, as Peter Lynch has said, and yet everybody continues to try to do it. And there's study after study that show that it's a detrimental effect to a portfolio. And of course, everybody is saying, yeah, but just think if I could have gotten out, before what happened in 2007 to 2009, and then if I would have gotten back in at the bottom in 2009. But it's impossible. You think of all the people who called the top.
Yep.
Many of them are sitting in cash, right? And they haven't enjoyed the rebound. So believe it or not, we've ridden through the ups and downs. Yes, guilty as charged. We're invested during the downturn, and guilty as charged, we're invested during the upturn. And happily, the winning years have won more than the losing years have lost. And we have this fantastic record. Our newsletter is the #1 rated newsletter, averaging about 18% a year in terms of returns going back to 1977. So when you have those kinds of fantastic long-term returns, you accept the fact that you're going to have the 87s, the 90s, the 98s, the 02s, the 08s. And I can assure you, Steve, that there will be another year when the market will go down and we will have miserable performance. And then there will be 2 or 3 years where the market will do just fine and will do even better, as we've done this year and last year.
Leverage. Do you use leverage?
We do not use any leverage at present in our portfolios. Our founder, Al Frank, as you know, he used some leverage in his own portfolio back when he was alive. Al passed away in 2002, and so he had used some margin. Now, when you think about going out and borrowing money to buy additional stocks, well, if you can borrow at 4% and make 10% or more, it's a great businessman's risk, just as Coca-Cola borrows money to build a factory, or good old Apple Computer borrows money to retire stock that was yielding more than the debt coupon, financial alchemy if ever there was it. Leverage is fine if used in moderation. From my perspective, though, at this stage of the market, I'm comfortable, just being, 95, 96% invested today. Now, if we have a big downturn, then we may want to use some leverage again.
Wow. Timing. Is that timing?
Well, you could say it is, but you're still looking at valuations. You're still looking at opportunities, and again, hindsight's always 20/20, and none of us can predict the future. But when today, for example, valuations, with PE ratios at 16, it's at the high end of historical range. Well, if PE ratio's at the low end, just that simple metric, you could say, hey, maybe it's time to use some leverage in a portfolio. But for the majority of investors, they're, especially after having gone through 07 to 09, the last thing they want to have is a turbocharged experience, going forward. Even though, of course, if you were fully margined this year, instead of being up 30%, you might be up, 55%.
Newsletter, you have different portfolios. Explain the difference. You have Buckingham, Millennium, Prooffolio, TPS.
Right. Well, we have newsletter portfolios, we call them. One is my own. Buckingham portfolio was launched in 2003. It's real money. It's my money. I believe in putting my money where my mouth is, just as our founder, Al Frank, did. We still manage Al's portfolio. It's called TPS portfolio. The one I mentioned has averaged about 18% a year since 1977, is TPS portfolio. We created 2 other portfolios that were, well, let's call them marketing things that we put out special reports at the Millennium. That's why it's called the Millennium portfolio. And then the subsequent year, we did another one called Prooffolio. Those are hypothetical, and those are assuming no leverage or anything like that. You had a finite amount of money, and you just moved forward with those dollars. And if you sold something, then you had cash to buy something. And so we have 4 examples for our newsletter subscribers to follow of portfolios.
Why 4?
We used to have 5, believe it or not. We called one. It's just really when the portfolio started, and it's just, I don't have a great reason for you to explain it, but, we want to keep track of the performance of those. And clearly, to have 2 real ones, Al's and my own, makes a lot of sense because, he was the first editor and I'm now the current editor. And then the two hypotheticals, well, we didn't want to get rid of those. They've both had fantastic performance since they began, well above the market. And so let's have a strategy that doesn't have any cash flows and outflows, which is what both Al's account and my account have.
So what is the difference between your account and the deceased founder's account?
Well, the difference is just really in the mix of stocks. And this is more to your point about, well, they're all sort of similar, right? We have similar holdings in all of them. The returns are comparable. Why not just, have one and make it simpler? And there isn't a lot of difference. But again, having said that, Al's account has had some withdrawals because the family might need some money and things like that. Whereas, knock on wood, my account, we've only put money in, not taking it out. Although if my daughter's tuition bills continue to go up, we may have to start taking some money out. And so again, this is the whole idea, is that you have people in investing who have a finite amount of money, and that's it. And they're not going to add or subtract for a number of years. And then we have our Pru-folio and our Millennium portfolio for those folks. And then there are people who may have normal inflows and outflows, and we have the two other portfolios for those folks.
Apple, is it worth biting into?
Well, yeah, when we did this Q&A, a year and a half ago, I was an optimist on Apple. Of course, Apple hasn't performed all that well since then, even though it's rebounded from the 400 level to the 500 level. I think Apple's a value investment, and I would be a buyer of Apple today. Part of the reason for that, of course, is valuation, which is why it's a value investment. You have a forward PE in the range of 12. You have a fantastic balance sheet loaded with cash. You have a company that has been buying back stock and actually retiring stock, unlike a lot of companies, right, where they're issuing more stock to employees and they're not really retiring. Apple's actually buying back stock. And of course, you have a fantastic product line. You have an installed base of customers that, we joke, if Apple came out with a washing machine, people would buy it because it's got Apple's name on it. And so there's a lot going for Apple, and the valuation is just really attractive in our mind. And again, the downside we think is mitigated by the strength of the balance sheet and the dividend yield. Apple, believe it or not, started a dividend a year and a half or 2 years ago. And to have that yield, which is now, I know, only 2.3%, but I'd much rather own the Apple equity, right, than the Apple debt that they issued earlier this year. Because believe it or not, had you bought Apple equity when the debt offering came out, you'd be up about 25% on the equity. On the debt, not so much. The 10-year notes are down about 11% from their issue price for one of the greatest companies, one of the safest companies out there, but they were paying 2.4% on 10-year paper. Again, Apple, I don't want to say they took advantage of, they stole, they did anything, they just took advantage of the market, which is one reason why I think you can be optimistic about equities, is borrowing costs are so low. Corporations have been refinancing their debt, lowering their borrowing costs, which of course goes right to the bottom line. And thank you, Mr. Bond Market. We're very happy to have you and all of the investors who are willing to accept, next to nothing. JP Morgan Chase, which, a company I like, if you're a great customer there, Steve, they'll sell you a 10-year CD at a 1% interest rate. Where do you sign up for that? But people do, because you know what? I'm not going to lose, quote unquote lose, but when you think of inflation, guess what? You've lost purchasing power.
So no Twitter or Facebook for you?
Well, valuation-wise, I just can't justify those. That's one of the frustrating things, is that so many investors glom onto the Twitters, the LinkedIns, the Teslas, and so forth. And some of those absolutely will grow into their valuation. They will become fantastic investments. Amazon being an example of that. Priceline. Many companies have actually grown into the valuation. But I'd rather buy businesses that are established, that have excellent, in my opinion, staying power over the long term, and I want to buy them on sale. I want to invest in businesses, not stock tickers that I hope to buy today and sell in the next 37 days because it hit a price target on my screen. I really want to invest in companies that I think will grow over the long term, and I just want to do that at a discounted price.
2014, market's done sensationally. Everyone's saying it's going to cool off. What do you say?
Well, I like that there's a lot of skepticism out there today. I think that's healthy. We see it in the media headlines, bubble stories. We see it even in investor sentiment. We follow American Association of Individual Investors sentiment survey. Believe it or not, the latest survey actually has less bulls than average in this 26-year-old survey. And there's still a lot of people who are underinvested, a lot of people waiting for the next shoe to drop, right? And of course, there's usually good reason for them to wait for that shoe to drop, because there's always something on the horizon, right? We still have the government having kicked the can down the road, and we seem to have forgotten that there's going to be another big debate in Washington in a couple of months to see if we shut the government down again. So there's still a lot of things for people to worry about, which is a good thing. The market will climb, historically anyways, that wall of worry. Now, having said all of that, to be sitting here up 30% or so in our newsletter portfolios and mutual funds, we have to keep things in perspective. You're not going to grow at that kind of level next year, in my opinion. Now, we could have the concept of a melt up as more and more investors come out of bonds. This is part of the reason equities have done so well this year, is that the money that had gone to the safety of bonds has all of a sudden opened their statements and found that you have red ink. Q2 was a horrendous quarter for bonds. And where did a lot of that money go when it came out of bond funds? It went into stocks. And so you could have a continuation of that, especially as the Fed ultimately starts to taper and interest rates move higher. So I think I'm positive for 2014. Where do I think we'll end the year? I'd be expecting returns in line with the historical average, which has been 10 to 12%. And 10 to 12% in an environment where interest rates are microscopic, would be a fantastic return.
Talking about microscopic interest rates, how does the Fed get out of the hole they've dug?
Well, that's the how many trillions? $4 trillion question. They do it slowly and they do it gradually. The first step, of course, is to stop buying $85 billion a month, and to try to do that without impacting the credit markets, of course, and ultimately the financial markets in general. And so they do it delicately. And they do what they say they've been doing, which is we are data dependent. So it's an if-then statement. If we start to see economic growth and some of the things that they've talked about as far as unemployment, obviously GDP growth, then they can start to unwind some of that, in my opinion, without causing great harm to the market. But having said all that, yeah, they're in this hole, right? And frankly, Uncle Sam is in the same hole, because we got to keep rolling over the $17 trillion or whatever it is in terms of the deficit. And there's a big difference between a 2% interest rate and a 3% interest rate when you're talking about, as they say in Washington, real money.
Favorite stocks for next year?
Well, I like companies that have, that in my opinion still have great long-term prospects and are suffering from, what I would envision are short-term difficulties. And frankly, I don't want to invest in the things that have gone up 80 or 90%. We own stocks like Navios Maritime, Manpower, Activision. I mean, we have some big winners in our portfolios. That's why we're up 30%. I'd rather focus on the things that haven't performed. I mentioned the materials sector. So names like Mosaic, names like Freeport-McMoRan, Copper and Gold, and even pure gold players, if you will, like a Newmont Mining. I like some of the consumer names, especially in the retail space, that have been kind of beat up here. One of those is Target. I think Target is an excellent value investment and a relatively safe investment with a very nice dividend yield. Now, another company in that space, if you want to be a little more aggressive, is American Eagle Outfitters, the teen apparel retailer. American Eagle has a fantastic balance sheet, no debt, $2 a share in cash, stock price down 20% on the year. We're a market that's up, 25%, as there are still bargains out there. And here's a company with a great dividend yield as well, over 3.5%. And that space, the teen retailing space, you go up and down with the fashion cycles. And frankly, you go up and down now with the economic cycles too. And so we had a tough time in the back to school season, tough time in the summer. And I believe those things are cyclical. If we believe the economy is going to grow faster next year than it is this year, I think we'll see a better backdrop, if you will, for the retailers. So retail stocks look attractive. I mentioned energy. Company like Holly Frontier in the refining space. Keep in mind the refiners had margins that were this wide, and then all of a sudden they contracted like this. Well, that's again a cyclical factor in my mind anyways, that ultimately will regress back to more of a mean. And so Holly Frontier, believe it or not, continues to pay out a huge dividend. Yield there is 7% when you count in the special dividends that they have paid consistently over the last couple of years. So that's an attractive name. And then we also like the big oil majors, the international ones, like a Total out of France, and Eni ticker symbol E, out of Italy. So lots of opportunities. I mentioned tech, big cap tech, certainly like Apple. And Cisco, given the beating it's taken here recently, I think is attractive. Intel, Intel has a dividend yield of 4%. IBM, another company that in my mind is still on track to make their $20 a share by 2015. It's stock trading at 175 or 180. That's an inexpensive company in any market, but in one where again, interest rates are so low and valuations are elevated for many companies, I think IBM is attractive as well.
Microsoft?
We can add Microsoft into that mix as well.
It seems to have been undervalued for 12 years now.
It has, and we haven't owned it for 12 years, but again, we've owned it for a while. But one of the things I think investors miss is that you're getting a big dividend. So when you think about total return on some of these companies, yeah, your stock price may not have gone that very far, but you throw in the dividends that compound over time, and you still get a decent return. So I like Microsoft, but Microsoft has actually performed a little better than the others here lately, with the Ballmer exit being a catalyst, which of course if you're Steve Ballmer, you're probably not too happy about having the big rally in the stock. But some of the other names I mentioned, haven't had the big rally up. Of course, I still like Apple, which obviously thanks to Carl Icahn has certainly had some interest from investors. And has run up from the low 400s to the 500s. But we've been in Apple a long time, having first bought it at $7 back in 2002, 2003.
That's great. Too bad Adam and Eve didn't have that kind of Apple. And then in terms of indexing, the rap against trying to pick stocks that eventually it all goes to the mean.
Right.
So why waste the fees?
It's a very fair point, and the fact that ETFs have come around and you can buy any kind of ETF, slice and dice the market in many different ways, is a positive on the one hand because, as you mentioned, it's a lower cost way to play. But as I like to say, there is value in active management, obviously picking and choosing the stocks within the index that you think are attractive. But perhaps more importantly, the value that I guess I would like to think I have is, in our newsletter we talk about the market, why you should think about long term, and we provide that perspective. Because if you're a do-it-yourself investor, it's very easy to click that mouse and say, sell everything, my 3 ETFs, I have an S&P 500 ETF or what have you. And it doesn't matter that the spider is really inexpensive in terms of an ETF, the S&P 500 index, if you didn't own it, right? And so we hopefully counseled our clients and our subscribers to stay with it. Yes, this too shall pass. This is one of Al Frank's favorite expressions. Everything will pass, and in the fullness of time, investors will be rewarded for their patience. And there's the old saw that says it's different this time. It's never different. Fear and greed, that pendulum will always swing, and everybody ran to that one side of the boat, the fear side of the boat, parked their money in low-yielding instruments, and so many of them are still there, and some of them have come back to the other side, but that boat, if you want to think, or a pendulum, is still tilted in favor of safety over what some would argue is risk assets. And so I think there's still ways to go on that front. But ETFs are great, and if you have that ability to buy it, put it away, and stick with it, absolutely stick with an ETF because I don't know the exact percentage, but 90-something% of active managers don't outperform their benchmarks. Well, happily we do, so we're one of the minority, if you will, that does. But most people don't have that discipline.
Why
to stick
hasn't
with
more
it.
money come to you?
Well, we do all right, Steve. We manage about $700 million, but that's the big question I might ask is, we have capacity, believe it or not. We're still open. If you want to write us a check for your personal account, we'll be happy to manage your money. To be serious, we're an acquired taste. Value investing is not sexy, right? It's not, popular with a lot of people. And so, we're not day trading. We're not making promises that, hey, Steve, will protect you on the next, 2007 to 2009. Well, if we see it coming, of course we'll protect you. But, to be honest, in 2007, valuations were not excessive. There was still a lot of undervalued stocks out there. Hindsight's 20/20, right? They became even more undervalued. But we're not going to be the ones that promise you that, hey, we'll get you out of the market, which in this environment, frankly, is what a lot of people want. That even though it's impossible, right, to time the market, if you make that promise to people, you're going to attract more assets. We just do what we are, which are funny grammar, but we are what we are. We just, we buy broadly diversified portfolios of undervalued stocks, and we harvest our profits and pull some of the weeds over time, and then replant and repeat the process. And like the tortoise and the hare, not too many people bet on the tortoise, right? But the tortoise won the race.
Thank you, John.
Thank you, Steve.